Hey everyone, happy Thursday, October 17th. It's about 11:40 in the morning on the West Coast, and it's time for another market update. My apologies for not sending one out last week. I was on a family vacation and I had some technical difficulties getting it recorded and uploaded from the rental house. But based on the way the last 2 weeks went, I might never go on vacation again because it wasn't a good 2 week period for mortgage rates. So let's take a look at what exactly happened. So basically, the first day I was on vacation, October 4th, the big BLS jobs report came out for September. This has been our nemesis for a couple of years now. What happens is this number comes in really high, and then throughout the year they make negative revisions, and it ends up being not as strong as it looked on the surface. But the markets have already reacted, and that's what happened here. Where the jobs report was supposed to come in about 140,000 jobs created, came in at 254,000. Big jump there, and unemployment was supposed to stay where it was at 4.2, and that dropped to 4.1. So taking a look at a graphic here, so again, you can see a big jump here month over month. Not only that, but they made some positive revisions to July and August. Full-time work jumped a bunch. Normally they're making negative revisions, but they made positive revisions actually. Wages were up. So overall, this was not a good report for mortgage rates. Not that we want to see people lose their jobs or anything like that, but keep in mind that the Fed is paying really close attention to these jobs reports. In their mind, if the job market's doing strong, they are not doing any harm by having rates higher for longer. So we want them to feel like the jobs market's starting to weaken, or they need to whatever it takes for them to cut rates. So that tends to be they would cut rates to stimulate the economy. So if they think the economy's booming, if they think the job market's great, they're not as motivated to cut rates. So that's why any jobs report like this is really important right now. And again, this was a bad one for us. The mortgage rates did not react well to this. We'll get a little into that in a second, but not a good report. Not great to see. Again, not that I want to see people lose their jobs, but I definitely want to see the Fed cut their rates. So next big one we got was September CPI inflation report. PCE is the Fed's favorite form of inflation to take a look at, but CPI is an important one. They're taking a look at it. The markets are looking at it. And again, this one came in hotter than expected. Month over month, it jumped 0.2. That was supposed to be 0.1. Core went up 0.3. It was supposed to be 0.2. So that left us at a headline number of 2.4 and a core number of 3.3. That's much lower than these 2022 peaks. But as you can see, the core number hasn't come down, too much, maybe less than a point since September of last year. So kind of stagnated, as far as our progress there. As Barry points out right here, there is some lagging in the shelter data. So that's a big part of these numbers is how much it costs for rent and things like that. And we know they do a very poor job of calculating that, and it takes a long time for that to take effect. So that should help us in the future. But overall, after that jobs report coming out stronger, we wanted inflation to come in lower to maybe like stem the tide a little bit, but that didn't help at all, being hotter than expected. Next day, we got September PPI. So this is producer inflation. And again, this came in a little bit hotter than expected. Month over month was flat as far as the headline number, but the core number went up 0.2, hotter than expected. Overall, these are pretty benign numbers, but it wasn't like a big hit for us. It wasn't a good one that maybe would reverse some of the negatives. Again, it was kind of a little hotter than expected, not awful, but a little hotter than expected. So again, that wasn't well received by the markets. Next thing, today, this is the big one we got this week. So we got September retail sales. This is how much Americans are spending, in retail. And this came in hotter than expected. So it's supposed to be a 0.3% month over month, went up 0.4. We're at 1.7% year over year. So again, the Fed is looking at this and saying, hey, Americans are spending a ton of money. They're doing great. No one's by us having rates high, it's not a bad thing for our economy right now. So this is why this number was not good for us. We want to see people stop spending money. We want to see some weakness in spending. We want to see some weakness in jobs. We want to see inflation go down. So that would the Fed would think, hey, inflation's not out of control now. We can start cutting rates, stimulate the economy to make sure we don't go into a recession. So numbers like this, the GDP, jobs reports being strong, that's why it's so important for them not to come in looking too great for mortgage rates at least. So this was kind of a gut punch today. Next thing we got today was initial jobless claims. So people applying for unemployment. Supposed to be 260,000 after 258,000 is surprise last week. Came in at 241. So a big miss here. This coupled with some manufacturing data and that retail sales today was kind of a trifecta of negative stuff for us. So again, not a positive. Not a lot of positive data over the last 2 weeks. It's kind of a trend, not what we want to see with a Fed meeting coming up in a couple of weeks. We want data to go in our favor, kind of showing some weakness, things like that. So that way they're more aggressive with their cut at their next meeting. So, after that jobs claim, where does that leave us in rates? So, like I said, when I left, I think we're at 6.21, 6.25, maybe that Friday, that Thursday night, um, 6.68 today. So it's gone up almost zero point 0.4, or I'm sorry, almost zero point 0.5, almost a half a point in 2 weeks. And a big part of that was that BLS jobs report. So let's take a look at this in graph form, just from August. You can see the beginning of August of this year, you can see when the markets are like, hey, we're going to get a half point cut. We're going to get some cuts coming up at their meetings. Big drop. Oh, and then they changed their mind. Some narratives changed and it went back up. And you kind of see this downward climb we went into the stem of this where we got our cut. Things kind of, started climbing a little bit of a sell-off, but we're still hanging out. Here's that BLS jobs report. That spike, that one-day spike, giving up all those gains we had already had when that BLS jobs report came out. So that was not good to see. Basically, what this comes down, like we've talked about, the markets are not waiting for the Fed to make their rate cut. They start trying to price things in already, get ahead of it as we see the data. Hey, this is what they're going to do. So this is the markets thinking, yeah, hey, they're going to do a half point cut. Maybe they won't do a half point cut. They're not going to do a half point cut. When it jumps right here, this is the markets figuring out what we wanted is not going to happen because of this jobs report. So, that is, you can kind of see in graph form, as the narratives form and as the data came out, how it changed rates. So where does that leave as far as important dates coming up? We really need the data, coming out in our favor. We got a big PCE report on Halloween. Hopefully that doesn't come out too spooky. BLS jobs report the next day, and then the next week the Fed will make their rate announcement. Right now, when I left, I think it was 55% chance they would cut by a quarter point at their next meeting, and 45% chance they would cut by a half point. So 100% chance they would cut, and maybe, about a coin flip, maybe it could be a half point. Since then, now it's at 90% chance of a quarter point and 10% chance of no cut at all. So again, the markets are very, feeling pretty good. It'll be at least a quarter point cut, but that half point cut has disappeared completely. So that's kind of what ends up happening is the markets see this data and start building it in. So the markets are not waiting for the Fed, and the data is not in our favor. So let's hope for inflation to be lower than expected. Let's hope for not a crazy strong jobs report. Let's hope for any report basically coming out that's about the economy to show a little weakness so the Fed can cut rates. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope you guys have a great week, and let's hope for some good data. Thanks, guys.